sense of these numbers, let me get on board Rajani Sinha, who's the Chief Economist, Care Edge Group, and Siddhartha Sanyal, who's the Chief Economist and Head of Research, Bandhan Bank, who are now joining us. Hi, good evening to both of you, and thank you so much for joining us. Largely inline set is what we can see right now, but it's the nominal GDP that's come in lower. Now, remember last year in the budget, the government had given a rough estimate of 10-odd%, but it will grow at 8%, so it's substantially lower in that sense. What sense do you make of it, Mr. Sanyal, and what is your sense of the first cut of the numbers that have come out?
Well, I would say there is no surprise in the numbers. So the 7.4% number is perfectly in line with expectation. The sectoral trends are also quite in line with expectation. You are absolutely right that compared to the 10-odd% nominal GDP growth focus, now it comes around 8%. It's a challenge to maintaining the fiscal deficit ratio target. Also, the government these days are quite committed on the public debt to GDP number also. So it's a challenge for both. But having said that, I would like to highlight that if you see the track record of Government of India over the last several years, they have been very, very meticulous in meeting their targets. So while this is a challenge and they have to rise up to the occasion, I won't be surprised if they still manage to maintain the number, stick to the number, or more or less be there at around their forecast zone. I'll be surprised if they miss it by a significant margin.
Absolutely. Over to you, Rajni. First of all, your reaction to the numbers, and as Siddharth mentioned, he's not surprised by it. But the services sector in particular, including financial, real estate and professional services, is estimated to grow at 9.9% in FY25-26. Given your expertise in real estate, how sustainable is this high growth rate, Rajni, if you can tell us that? And what are the risks that could moderate this momentum, according to you?
So I agree with what Siddharth said. This number, the GDP number, is broadly in line with our expectations, and I would say market expectations. We were expecting GDP growth of 7.5%, and the number has come at 7.4%. So it's broadly in line with expectations. But if I look at the breakup, what surprised me a little bit was the growth estimate given for consumption and investment. So if we look at the GDP growth number given for consumption, basically it is factoring in that there would be some moderation in consumption growth in the second half of the year, which I found a little surprising because we were expecting the consumption growth momentum would pick up further because of GST rate rationalization, lower inflation and all those factors. And in fact, as per the advanced estimate, the investment data is showing further robustness in the second half of the year. So basically as per compared to our expectation, the consumption is moderating in the second half of the year, which is surprising, and investment is picking up sharply in the second half of the year, which could be challenging because so far what we have seen is that government capex has been strong and that has kept overall capex momentum strong. But private capex is still not very strong, though it has also started picking up. But broadly, if I look at the overall GDP number, it is in line with expectations. As far as, you asked specifically about services sector and whether that growth momentum will be maintained. I think it's quite possible looking at, the number that we have got for the first half of the year. And whatever indicators we are getting through high frequency indicators, looks like that they will be able to achieve good services growth for the whole of the fiscal year.
Right. Mr. Sanyal, let me circle back to you on the nominal GDP because, taxes grow on the back of nominal GDP, so does the earnings. Is the nominal GDP number a bit of a dampener, and perhaps in the second half, we could expect a slightly sub 7% number?
Oh, well, at this moment, if you go by the imputed numbers, the MOSPI is actually factoring in a number, growth number for the H2, which is slightly softer than 7%. That's why the average is coming at around 7.4%. I think they are also factoring that in. I would say like to say that yes, very clearly the tax collection, the revenue collection numbers are slightly softer. Also, if you actually see the net tax revenue part, because there is slightly higher devolution on states, that particular number is slightly even more softer. But all these things are actually making the stance of the government much clearer, and which is some kind of a reassurance factor to me that the government wants to come on the front foot and wants to provide some bit of support to the economy and to the growth momentum. They are in a position to do that because some of the other factors are well under control. Some of the constraining factors are well under control because inflation is very low. Fiscal deficit, irrespective of whatever we get to see in this particular budget, the numbers are quite subdued, at least at the central level. Also, the current account deficit is well under check. So some of these constraining factors are at very, very healthy levels. And that actually allows the government to focus a little more on the growth side, which we are seeing consistently from the government and various institutions of policy making. So that is quite encouraging, I would tend to say. The last point I would like to highlight, that in terms of the growth momentum of this particular economy, the bedrock for India's growth is actually the contribution from private consumption. And private consumption's contribution over the course of the last few years had really turned softer, which is now reviving again. On top of that, with all the support from moderate inflation, moderate interest rates, and most importantly, with low tax rates, my sense is that private consumption will be making some kind of a turnaround, which a process which has begun, and which should be providing quite a bit of a tailwind for the growth in the coming quarters.
Absolutely, Mr. Sanyal. Also, one point of data over here is that, the agriculture sector growth is estimated at a moderate 3.1%, and India being vulnerable to monsoon fluctuations. How can government initiatives also factor in for mitigating risks for farmers and also for rural consumption, according to you, going forward?
Is it for me?
Yes.
I think generally a most important long-term solution to that is to invest quite a lot in rural infrastructure in general. Over the last few years, we have seen consistent growth in irrigation facilities. We have seen a very important uptick in rural electrification, a very positive next step, and a very obvious corollary is to enhance agricultural storage or rural storage. I think work is going on that particular direction. So better irrigation, better agro storage, better agro marketing, generally better connectivity with the nearby towns, etc. All these things should be priority. There can be some near-term factors and near-term support in terms of providing some bit of insurance, providing some bit of price support. But my sense is that in the long term, if you want to insulate yourselves better for against this kind of shocks, and this kind of shocks are not likely to go away anytime soon, I think the most important factor to invest consistently in rural infrastructure. That's the key.
All right, Mr. Sanyal and Rajani, thank you so much for joining us and weighing in on the FY26 GDP estimates. We will let you go on that note.